Hello, hello. Alright. Alrighty. Let's do it. Let's do it. So, first things first, GameStop released Lunar Packs today on Pokemon, which is a $2,500 pack. Maybe we'll open one. I don't know. I don't know if I want to open this for you guys because all the people who watch my Power Pack videos, they're all like really negative, and why should I do this for a bunch of negative people, you know? So, I'll think about it. I'll think about doing it for myself, but to do it for you guys, well, the people who are here all the time, of course, I would do it for you no matter what, but like to do this for the overall community is a waste of my time because nobody cares about this channel, nobody cares about this stream. Most people don't care about GameStop. They just like to get clicks on their little Twitter posts and stuff. So I don't know, but it's pretty cool. I like the animation, and I really do want to open one, but we'll see. We'll see. It's not going to be today. But what we are going to do today is we're going to read Michael Burry's article that he wrote. It's not about GameStop, but he wrote a new article, and I thought it was actually really interesting. I read it last night, so I wanted to stream it. And I think in the last live stream, we read the introduction article on his Substack. Hopefully it's still here. Did it get deleted? What? Michael Burry might have forced Reddit to take it down. I don't see it. It might have got taken down. Oh, there it is. Okay. There it is. Okay. I was like, bro, that would have been annoying. I mean, I would get why they would take it down. You have to pay like $400 to get into his Substack. So, it would make sense for him to take it down. Sorry, I am sick as fuck right now. I shouldn't even be on stream. Hold please. I'm dying right now. So, what was I gonna say? I was gonna say something, but I started dying. Oh yeah, this article isn't about GameStop, but it should give you a good view on GameStop. Like, it should give you a different. It should just give you a different opinion on why, potentially maybe why I like GameStop so much. And yeah, it's just we'll just read it and you'll find out. There's a whopping 2 people here, so hope you guys are doing good. God bless you. All right. And shout out to this guy, Drew Dada 2. He posted this on Reddit. So shout out to you. This is a $400 a month article, basically, because of Michael Burry's Substack's $400 a month. So the fact that this guy just shared this, shout out to him, Drew Dada 2 on Reddit. I almost said Twitter. I actually deleted my Twitter because I'm done. I don't. I'm sick of social media, bro. YouTube is it. I'll come in here and do what I want to do, and that's it for social media for me. All right, let's get into it. And like I said, I'm really sick, so sorry if there's a lot of intermissions. I'm just getting over being sick, so all the disgusting ass shit is. I feel like trash still. Varley, what's up, bro? What's up? I'm good, bro. I'm just sick right now. Other than being sick, life is good. All right. So this was uploaded last night. And also, we ended off the stream with it. last stream, but GameStop did announce their earnings date for December 9th. So that's awesome. That should be pretty cool. Well, I'm excited to see what numbers they post. But anyway, one sec. Good lord, son. I need to go to the gym after this stream. All right. Anyway. All right, let's do this. Let's do this, chat. There's not that many people here. I'm actually going to close the chat because nobody types in the chat anymore. So if I'm slow to responding to your chat, it's because I don't even have the chat up. But, God, dude, this is going to suck. Reading while you're sick sucks. Okay. Foundations, the tragic algebra of stock-based compensation. I watch a lot of Big Bang Theory. If that does not look like a Nobel Prize, Alex Karp is not a doctor. But no, I do not claim such a surprise. This derivation belongs to my right-hand man at Scion the last 4 years. Phil Clifton is his name, and he's quite literally a rocket scientist. Engineers make great analysts in my experience. Phil is launching Pomerium Capital and giving it a go. You might want to check him out. He hates it when I call him the next Buffett, so I'll not call him that. Now let us move to what it all means. My apologies in advance. I'll be thorough when you least expect it. John Burr Williams in 1938's The Theory of Investment Value was one of the first to lay out a formula for valuing a security. Namely, that any security is worth the discounted sum of its future cash flows. This discounted cash flow approach is today the foundation of business valuation, but is generally employed, it falls short of accuracy for companies that routinely issue billions of dollars worth of stock-based compensation. While tech companies today are no longer engaged in clearly unethical 2000-era practices, such as backdating stock options, there are still catastrophic ways in which value is diverted to enrich management and employees at the same expense of shareholders. Whereas equity compensation was once reserved for board members and top management, the practice has spread throughout companies and even down to new college graduates, who often see equity compensation as a significant part of their total pay. The last decade or so, this has resulted in an explosion in stock-based compensation, costs that are not adequately captured under the God, this sucks. Under either generally accepted accounting principles, expense guidelines on Wall Street, or Wall Street's adjusted earnings and estimates. In fact, Wall Street analysts add back GAAP SBC costs, effectively eliminating SBC as an expense in adjusted earnings and estimates. The companies themselves are no better, often presenting their own adjusted earnings in this matter. Media obliges, and disinformation is spread with bullish intent. If you learn nothing else in this note, remember not to add SBC back. Warren Buffett mentioned this in the 2018 Berkshire Hathaway annual letter, released February 2019. For example, management sometimes asserts that their company's stock-based compensation shouldn't be counted as an expense. What else could it be? A gift from shareholders? ? One sec. I'm dying, chat. Ugh. I'm dying, chat. Being sick sucks. I want to show you guys a funny comment real quick. Why does everyone think I live in an apartment? I don't know why. Is that just what broke people do? Do they like push their insecurities on others? Like even if I did live in an apartment, there's nothing wrong with that. Being a homeowner is not easy. Anyway, it is indeed a gift, a transfer from stockholders to employees. As an owner of common stocks representing minority, non-controlling stakes, our view is that the dilutive nature of SBC must be taken into account by either 1. Acknowledging the discounted cash flow analysis that excess capital must be perpetually set aside year after year to offset the dilution, or 2. Accounting for the fact that our stake of the business will be continuously whittled down by new share issuances. It turns out that traditional DCF math can be modified for a precise accounting of this perpetual dilutive effect. The full derivation is posted at the bottom of this post. In short, the familiar formula for the present value of a security paying out growing cash flows is CF divided by D minus G. The above formula does not do well when the growth rate approaches the discount rate, for obvious reasons. Most consider the discount rate to be a number blended from cost of capital and cost of equity. This weighted number is rarely higher than 15% or so. As a result, a perpetual growth rate nearing 15% makes most present value calculations approach infinity. The formula works well. However, because nothing created by humans has ever grown at 15% into perpetuity as far as we know, so if you're getting near infinite present value, you are likely too optimistic about that growth rate. For most investors, 50 years may as well be perpetuity. A 2024 Goldman Sachs study estimated S&P 500 turnover at 36% during an average 10-year period. If that holds over the next 50 years, only about 11% of today's S&P 500 companies will still be in the index. Over 50 years, nothing humans have ever done has beaten Moore's Law. Gordon Moore, R&D director at Fairchild, proposed in 1965 that the number of circuits on an integrated circuit chip would double every year. He co-founded Intel in 1968, and then in 1975, he revised Moore's Law to a doubling of circuits on a chip every 2 years. Here we are in 25, and Moore's Law is held up incredibly. That is about 41% annually for 50 years. Nothing else man has created in modern era has grown almost 30 million times in 50 years, like the number of circuits on a chip. The semiconductor company that comes closest to matching this record is Taiwan Semiconductors. TSM is the ticker. TSMC has grown its revenue about 18% annually since listing on the Taiwan Stock Exchange. Amazing for a manufacturer, but not Moore's Law good. By the way, Intel has grown its revenues 13.5% since 1975, despite only growing at a 2% annual rate since 2000. Away from hardware, Microsoft designs the most popular applications running on these chips and has grown its revenues at an almost stunning 25% rate since NASDAQ stock listing in March 1986. Today, in 2025, Moore's Law is slowed to a doubling about every 3 years, bringing annual growth rate into the 20-25% range. Meanwhile, Microsoft's growth has slowed to 12% over the last 10 years, and TSMC's growth has slowed to 15% over the last 10 years. Unfortunately, those first 20-30 years do not really continue in perpetuity, even the most amazing companies. Even so, attempts at valuing future cash flows on these companies back in 1987 would not have come close to reality. Accurately predicting 15% growth over many decades would take not only the existence of that one company, but also an analyst benefiting from luck above all else. I mean, you could say that about GameStop for sure. My predictions for GameStop over the decades is very high growth, but realistically, who knows? But I mean, I think that's the beauty of it, is because people are so focused on, you know, what they see right now. They're not looking decades out in the future. If GameStop starts to grow every single year, it could become, you know, it's not a chip company, or it's not Microsoft, but it could still grow to a massive level. And, you know, with really good accounting, if GameStop, if my theory is correct and GameStop is not showing as much as they are actually earning, with proper accounting, you know, they could be earning a ton over the next few years on paper, and, you know, actually like hiding what they're actually making, which, you know, a lot of companies do to make themselves look better. And, you know, like my theory, I think GameStop's using accounting to make themselves look worse. But, you know, 10, 20 years down the road, that's tough to predict. GameStop's now over $23. A bunch of people, you know, like a week or two ago were telling me it's going to go to 15 or 17, or it's kind of interesting how quick the sentiment changes. You know, if you're going to have an opinion about the stock, you should probably short it. Because the only reason a lot of you guys have your negative opinion about the stock is because you want to see me lose, but I'm not going to lose. So you're kind of screwed if you think I'm going to lose. Anyway, okay. If you think you can catch lightning in a bottle and ride the exact right high-tech company for the next 35 to 50 years, you can stop reading. This formula and its insights and relationships will not mean much to you, and I can offer nothing of value to you. I mean, I don't know if I can predict GameStop for 35 years, but the next 5-10 years, I think they're pretty predictable. You know, not on the stock price, but for a business valuation, I would say the next 5-10 years is pretty predictable. I closed the chat. Let's see if anyone pulled up. What is it going on with the stream? Is the stream... Bro, the stream's clapped? What is going on? Are we live? What the hell happened? Hello? Let me close that. Close that. Close that. Close that. What is going on? Am I live? Hello? Hello? Am I live? Are we good? Where the hell did I leave off on? What happened? I didn't even notice. I didn't even notice it was lagging. I guess that's why you gotta have the chat up at the top. I guess that's my fault for not having the chat open. Are we good, though? Are we live? Hello? I don't know if anyone's in the chat. Let me know if we're still alive. I don't know what happened. And I don't know where the stream cut off either. Does it tell me? I don't think it tells me where the stream cut off. What's up, Muma? How you doing, bro? It's been a while. It's been a while. Hope you're good. I don't know where the stream cut off. My internet and computer has been garbage lately. This thing is... Does anyone know where we left off? Like, where did the stream start lagging? I didn't get to see. I'll just reread a little bit. I'll just go back a little bit and reread, because I don't know when the stream started lagging. Let's see. Microsoft's revenue's grown at 25% since 1986. In 2025, Moore's Law is slowed to doubling every 3 years. Microsoft's growth is slowed to 12% over the last 10 years. Unfortunately, those first 20, 30 years do not really continue in perpetuity. Attempting at valuing future cash flows on these companies back in 1987 would not have come close to reality. Accurately predicting 15% growth over many decades would take not only the existence of that one company, but also an analyst benefiting from luck above all else. Yep. Okay, that's probably where we left off then. The rant about bearish people, yeah, that's where that started. Bearish people aren't very smart. Let's see. If you think you can catch lightning in a bottle and ride the exact right high-tech company for the next 35 to 50 years, you can stop reading. This formula and its insights and relationships will not mean much to you, and I can offer nothing of value to you. For mortal companies and their mortal investors, we, after 2 whiteboards of algebra, turn that tried and true, accepted and simple present value formula into something a little more useful. Our updated formula for a security paying out growing cash flows, but also suffering dilution, is CF divided by 1 plus D multiplied by 1 plus Y minus 1 plus G. CF cash flow in first year, D equals discount rate, G equals growth rate, and Y equals dilution rate. This formula shows precisely how damaging the dilution from stock-based compensation is to owners over time. Just as importantly, the equation sets out the relationship between each of the factors and present value. This is where the article gets good, bro. This is where the article gets good. This is where the article, like, if you're a GameStop investor, this is where you, like, really start to think about, like, holy shit, GameStop really might be the greatest investment of our generation. You know, there's many reasons for that, but if this is something you haven't heard about before, which of course I knew what stock-based compensation was, but I never really thought about it in a dilutive sense. So this is actually really interesting. All right, so take 2 identical companies, A and B, both are growing at 5%, and both discounted at a 10% rate. Company A pays employees only in cash, not SBC. Company B, on the other hand, uses SBC for part of its compensation and dilutes owners at the rate of 1% annually. All else is held constant. In this scenario, the fair multiple of earnings to pay for Company A is 20x. But Company B, despite being identical in all other respects, would be worth only 16.4x. These 2 plots show how significant even sub 1% amounts of dilution dramatically reduce value. Higher growth rates would solve this, correct? ? No. Companies with higher growth rates are especially hurt by dilution. Outgrowing dilution for purposes of achieving maximum present value for an enterprise is not easy. Tesla dilutes its shareholders at about 3.6 per year with no buybacks. The chart above shows the kind of present value destruction that this level of dilution can impart. With recent news of Elon Musk's $1 trillion pay package, dilution is certain to continue. Tesla's market cap is ridiculously overvalued today and has been for a good long time. As an aside, the Elon cult was all in on electric cars until competition showed up, then all in on autonomous driving until competition showed up, and now is all in on robots until competition shows up. Another beauty is Palantir, which has been diluting shareholders at about 4.6% annual rate despite buybacks. Palantir has no earnings after adjusting for stock-based compensation. Palantir has the distinction of being the first billionaire revenue ratio greater than 1 that I have seen. 5 billionaires due to stock ownership, and less than 4 billion in annual revenue. Amazon steadily dilutes its shareholders at 1.3%, or so despite a short 6 billion buyback a couple of years ago. 1.3% is less than with Palantir or Tesla, but still penalizes shareholders, as the chart above shows. Amazon has had $220 billion in net income going back to 2018, and the dilution from adding 935 million shares over that period of time would be worth $233 billion today. Dude, that part is crazy to me, bro. That part is fucking crazy to me. Because I mean, look at Amazon's market cap. You know, Amazon's market cap is, what is it? I forget. 2.5 trillion. So you're telling me there's a whole 200 billion, like this should be 2.7 trillion market cap, essentially, is what Burry is saying. They've taken 200 billion away from shareholders, basically. Crazy. And like, if you think about that in context with GameStop is diluting shareholders to bring cash into the business. They're not using, well, I think Daniel Moore and the other, I forget the other guy's name for some reason. Those guys get stock-based compensation. And maybe a couple other board members might get stock-based compensation. I'm actually not 100% sure. But if GameStop is doing like barely any stock-based compensation, and anytime they do dilute shareholders, they're doing it to raise cash for the business rather than paying out like employees and stuff, then the future value of GameStop is going to be exponentially higher than what I think it might be potentially. Like, I don't know, you know, who knows what's going to happen, but like, if you're thinking about it in that form, like, GameStop's not there to pay out employees or anything like that, really. You know, they're paying out the employees who deserve it and what all that, but like, the goal of GameStop is to bring shareholder value. Load any on the dip. I bought it like 21. I bought it 21. I went all in at 21. I don't know. They did an update. They did an update on the ads. I'm not really sure what happened. For some reason, there's no screen names anymore. It's just ats, which is pretty good because a lot of people's screen names are, you know, people. There's literally someone who gets banned and then they make a new account just to like have a screen name on. I don't know, but so I'm kind of glad they updated it, but it is a weird update. So yeah. Anyway, sorry I went on a little tangent there, but if you're just thinking of, I don't know, if you're actually listening to what I'm reading, the shit is interesting. But there's only 4 people here, so I'm sure most people aren't listening. Most people don't care, bro. They don't see it, bro. They don't see it. They just want to see me lose, but little do they know. Little do they know. Oh, okay, so Amazon, let's see. Amazon has had $220 billion in net income going back to 2018, and the dilution from adding 935 million shares over that period of time would be worth $233 billion today. Well, what shareholders gave employees has more value today than what Amazon carried under GAAP accounting. Oh, what's up, KCR? What's up, bro? I hope you're doing good. Am I crazy? I took a loan out when we went down to 20. You're capping, bro. I mean, if you're being serious, that's fucking awesome. I don't know how smart that is. I don't know how it's gonna work out for you, but oh man, that's fucking hilarious. That's fucking hilarious if true. Hold one sec. Sorry, currently dying. I'm just getting over being sick, so sorry about that. Yeah, dude, I haven't seen KCR or Muma in here in a while, so I'm glad you guys stopped in. Glad you guys are doing good. Now I need to... Where's Matt Romano been, bro? I haven't seen Matt Romano in here and couldn't tell you how long. New job's treating me well. I'm actually growing towards goal. Growing towards God. Ooh, hell yeah. That's beautiful, bro. That's beautiful. I love to hear that. Probably got that big Gme energy. I really did. Bought a Gme. Let's go. I hope it works out, bro. I hope it works out. Just be careful with that. Just be careful. You know, I do advocate taking profits when they're there, but you do whatever you want. Just be careful, bro. You know, I don't think it's really gonna go. I was surprised it hit 19. Sort of. You know, I kind of felt like it could go down that low, but you know, I don't really think it's gonna go much lower below 20 personally, but anything's possible, you know? Anything's possible. But that's crazy. That's crazy. Mostly very sad. But, I mean, fuck, dude. It doesn't even matter. If you're looking out 5, 10, 20 years, I don't think the price matters, bro. A lot of people are way too focused on the short-term price action. Like literally, 2 weeks ago, everyone was bearish. Everyone thought it was going to go below 20. And, you know, it did go below 20 for like an hour or some shit. Didn't go below 20 for very long. But there's no difference. 20, 15, 25, 30. If you're looking out decades, it doesn't even matter what price you're buying it at. But people don't look at it that way for some reason. People are way too focused on the price action rather than focusing on, dude, you're investing in a business that could potentially add, you know, 40, 50% of shareholder value in a single year. There's not a single bit, like, I don't think, you know, enlighten me, please, but I don't think there's a single business on the stock market that can add 40 to 50% shareholder value in 1 year. There's not. Like, there's a lot of companies making a lot of money, but when you're looking at it from a shareholder value perspective, there's not one company that can produce the shareholder value that GameStop can produce. One sec. Oh, God, dude. This sucks. Being sick sucks. Pray for me. Pray for me, KCR. I think I'm actually getting over the sickness, which is nice. I didn't really get as sick as I could have got. Let's see. Very satisfied of where my life is going. Good, bro. I'm glad to hear that, bro. I'm glad to hear that. KCR found God on the tip. I don't think KCR really cares about the price action. Like he used to, you know. We have a lot of history with KCR. There was a time where KCR did care about the price action, but I don't think KCR cares about the price action anymore. I think he sees what we all see. And, you know, being down sucks, but, like, it's part of the game. It's part of the game. Unless you're a professional day trader. Being down on your investment is part of the game. Varley leveraged himself. More amazing news. I think that's hilarious, bro. If you got a stop loss and make the monthly, where's the risk? I'll send you the new foundry. The father. Yeah, that's beautiful, bro. That's beautiful. Getting close to God and I don't know if you're like into a specific religion or anything, but it's good to have that faith, bro. It's good to have that faith. Price action isn't doing much of anything anymore to me. That's good, bro. That's where you want to be, straight up. That's where you want to be. Anyway, of course, in practice, many businesses opt to repurchase stock to offset at minimum the dilution of their SBC programs. In this case, owners are not technically diluted. Rather, the capital spent on buybacks becomes a mandatory drain on cash flow that is typically far in excess of reported GAAP SBC expense. That cash drain has a negative effect on intrinsic value, akin to dilution. Such buybacks represent a true cost that penalizes both present value and potential long-term returns. Many of our most popular companies, such as Nvidia, are engaged in buybacks to nowhere, where the cash spent on repurchases does not reduce share count. Non-cash does not mean free, not to an owner, not to a shareholder. I'm curious if GameStop will do buybacks. What do you guys think? Do you guys think GameStop will do buybacks at these lower prices? Like, do you think they bought back shares at 19, 20, 21? I don't. I think I think they're betting on retail to hold up the stock, personally, and I think putting cash into the stock market is a stupid idea. I think keeping the cash in the business is a good idea. But if they are doing buybacks, that is very beneficial to shareholders at these lower 20 prices. Because, you're just, they're holding up the price. They would be showing that they're willing to hold the price at $20. And as a shareholder, I would say that's valuable. Putting all that cash into the stock market, that's not valuable because shorts are just going to keep shorting the stock. But GameStop has so much cash that they can support the stock at that price. But I do agree. I think buybacks are a waste, but you got to think your last at the money was at like $23. So you would be buying back shares 10% lower than your lowest at the money. And your highest, your first at the money was at like $60. So you'd be buying shares back at like 60% of when you did the at the monies. So, buying back shares at these lower 20s is valuable, but I do agree with you. I think keeping the cash in the business would be better. It would just be nice to see as a shareholder that GameStop is willing to do buybacks, even if it's like a small buyback, even if it's nothing crazy. If it's like 100, 200 million, they buy back a couple million shares or, a few million shares. Like that would be valuable. Don't dump 500 million or a billion on buybacks, but like 100 million, 200 million, why wouldn't you do buybacks? They bought Bitcoin. Bitcoin's fucking garbage. If they would have put that 500 million into GameStop shares, as a shareholder, I would have appreciated that move more than buying fucking shit Bitcoin. Like, Bitcoin's garbage. So, Insider buy to me is worth more than a buyback. Yeah, but insiders can only buy every now and then. I think buybacks can be introduced at any point in the market. Because, last time we hit lower 20s, you were seeing insiders buy. But insiders can't buy right now. So, but GameStop could do buybacks right now, I would assume. I don't know, I don't know, but anyway, sorry, I got distracted. Went on a rant, a tangent. Okay. Okay. So, of course, in practice, many businesses opt to repurchase stock to offset at minimum the dilution of their SBC programs. In this case, owners are not technically diluted. Rather, the capital spent on buybacks becomes a mandatory drain on cash flow that is typically far in excess of reported GAAP SBC expense. That cash drain has a negative effect on intrinsic value, akin to dilution. Such buybacks represent a true cost that penalizes both present value and potential long-term returns. Many of our most popular companies, such as Nvidia, are engaged in buybacks to nowhere, where the cash spent on repurchases does not reduce share count. Non-cash does not mean free, not to an owner, not to a shareholder. Following Warren Buffett's Yellow Brick Road, I seek to find owners' earnings for use in any valuation proceeding. Owners' earnings will differ materially from GAAP, but in the spirit of honest evaluation and correction, rather than the proverbial lipstick of the proverbial pig, to get started, I put quarterly financial statements for the period side by side across the computer screen in Excel, as below, both to help me find patterns and do quick math. 2018 is a good starting point because it encompasses before, during, and after COVID, as well as Nvidia's twin drivers, crypto, and AI. As well, this sort of analysis should be done over a number of years, because one purpose is to estimate likely future impacts on owners' earnings. Scanning for patterns, I spy a squiggle, a too large inventory build/cash flow outflow in operating cash flows. I make a note to investigate this another time. I turn back to the stock-based compensation analysis. For simplicity in this analysis, I deem working capital changes and all other line items in the OCF a wash. Best to hold these constant and isolate the effect of SBC. Since the beginning of 2018, Nvidia has bought back a remarkable $91 billion of its own stock. Also during the period, Nvidia earned $205 billion in cumulative net income, but produced only $188 billion of cumulative operating cash flow. Largely due to the aforementioned working capital changes, this analysis follows from net income in order to focus on SBC. Often in full analysis, I start with operating cash flow. Total capital expenditure over the period is minuscule at $14 billion because Nvidia does not fabricate its own chips. It is fabless. Cumulative depreciation since 2018 is just $6.5 billion. I accept that number for this analysis as a proxy for maintenance capital expenditures already embedded in net income number, and I move on. Also in the cash flow statements, we see GAAP mandates the addition of non-cash cumulative $20.6 billion GAAP SBC expense back to reported operating cash flows. This, of course, boosts operating cash flow. I then flip to the balance sheet to check how shares outstanding have changed over time. With $91 billion in buybacks, surely owners' earning per share benefits from substantial drop in share outstanding. Instead, I see at the beginning of 2018, shares outstanding were about 24.3 billion, and today I see the number is, surprise, 24.3 billion. Actually, 47 million shares more, but I round down. This buyback to nowhere is common among technology companies. I saw Moose on Friday, but nobody really comes in the stream anymore, and if they do, they don't type in the chat. So a lot's changed. A lot's changed. Imagine if Burry will buy GME again. It's possible that, the upswing from 19 to where we're at now is Burry buying. Potentially. We'll see. And today I see the number is, surprise, this buyback to nowhere is common among technology companies. Nvidia therefore spent $91 billion of its $205 billion in net income without changing the share count. I must factor this into owners' earnings, as it is a significant transfer of wealth from shareholders to employees. That original cumulative GAAP SBC expense, $20.6 billion, is now irrelevant, may as well be imaginary, never an expense. Replacing GAAP SBC expense with the $91 billion buyback to nowhere expense results in total owners' earnings at $135 billion. First time I caught you live since I seen you been back. Yeah, I've only been streaming for like an hour, if I even stream at all. Streams are less frequent, but I understand. Yeah. I mean, I want to stream more. There's just no content to stream about, straight up. If there was actually content, if there was actually things to talk about, I would stream more. And YouTube cut my earnings. Like, I'm earning less on YouTube than I ever have before. You know, part of it's because I'm not uploading or anything or not streaming, but even if I was streaming, I would still they clap me, bro. Like, so it kind of sucks, you know, from a money making perspective. It's hard to not make money in a lot of cases, even though, you know, I think GameStop's going to work out and it's going to make me a millionaire. In the short term, you know, it's like, fuck, dude, I need to be doing something that makes money, but you know, money doesn't really matter when it comes to streaming. It's more just, I don't know what to talk about. Like, how we did 6, 7, 8 hour streams consistently, I have no fucking clue. I get like an hour in and I'm like, what do we even talk about? Like, I don't know. So it's, yeah, believe me, I want to stream more. But it's just hard, man. It's hard. Been a slave at Bezos? Nice. That's fire, bro. That's fire. Short term, making money is important. Same for me. Long term, I'm pretty set, probably. Yeah, that's what I think. I mean, who knows? You know, who knows? But I'm trying to get back on the grind. I don't know, you know, something really exponential would have to happen to go back to 6, 7 hour streams, but you know, I want to try to stream like an hour or two a day if it's possible, if there's actually like things to talk about. Okay. Across 2018 present, a remarkable run for company NVIDIA Across 2018 to present, a remarkable run for the company. NVIDIA owners' earnings appear to be 66% of the gap's cumulative $205 billion in earnings, and 60% of Wall Street $226 billion. If I use only data from Bloomberg, I am done. Bloomberg says $91 billion worth of stock was bought back from 2018 to present. It has another cash outflow it calls other financial activities. That is typically a cash outflow, but does not appear linked to SBC. Nevertheless, additional SBC-related expense lurks there, so I'm not done. Another significant cash transfer from shareholders to employees hides out in the financial statements far away from most typical free cash flow calculations. This is how it works. Typically, when a company grants stock to employees upon the vesting of restricted stock units, the company grants those shares to the employee on a net basis. The company then uses its own cash, as with a normal paycheck, to make the legally mandated tax withholding payments related to the RSUs. I think restricted stock units is what Daniel Moore and the other guy gets. Per the FASB accounting standards, update 2016 to 2019, these RSU vesting related tax payments are a line item in the cash flows from financing activities. The highlighted area before shows these tax payments sitting just under the stock repurchase line items in NVIDIA's consolidated statement of cash flows. When a company withholds tax from a paycheck and sends it on to the IRS, the total cost of the company is still, of course, the whole paycheck, inclusive of the tax. The cost of the company of SBC is also the whole paycheck, the cost of the grant of stock on a net basis plus the cost of the withholding tax payment the company makes. In NVIDIA's case, because the 2018 to present grants of stock were almost entirely offset by $91 billion in buybacks, we can easily calculate $91 billion in one part of the cost of those grants of stock. When this equivalence does not exist, the calculation is just a few more steps which we will address another time. For NVIDIA, Those 2018 to present withholding tax payment related to vested RSUs amounts to $21.5 billion. NVIDIA's whole SBC paycheck from 2018 to present is therefore $91 billion plus $21.5 billion for a total of $112.5 billion. This reduces NVIDIA shareholders' owners' earnings from 2018 to present to just $114 billion. That's crazy, man. You know, these are multi-trillion-dollar companies, but like if you're a shareholder, that's a lot of value they're taking away from you. You know, if that was $100 stock or $1,000 stock with $1 trillion or $2 trillion market cap, like they're taking what, like $50 per share away from you, basically. I think, you know, I don't know the math off the top of my head, but I think it's about 50. If it's 2 trillion, I think it's 50. If it's $1 trillion, I think they're taking like 10% of your earnings. So that would be like $100 per share. Like, that's crazy. If I'm doing the math correct. You know, I did that in my head, so I don't know, but I think that's right. This is 56% of NVIDIA's reported GAAP earnings and 50% over Wall Street's earnings over the 2018 present period. This is also where NVIDIA says I made a mistake. NVIDIA, rather incredibly, sent a memo to its most influential fan base, its Wall Street analysts, hoping to inspire them to attack me and my logic on this matter, as well as others. NVIDIA claims that I incorrectly included the $21.5 billion in cash RSU-related tax payments. The same $21.5 billion we just discussed above as being part of the whole SBC paycheck. And the total cost of SBC program. Misleading. The company's cost, the owner's cost, is the full value of any compensation, not just the portion the employees take home after taxes. Such is the truth for an owner whether the cost is stock-related compensation or cash compensation. The $91 billion in share buybacks plus the $21.5 billion in RSU-related tax payments is NVIDIA's total cash cost of issuing stock to employees since 2018. That is $112.5 billion, is the whole SBC paycheck, as already established above. NVIDIA then engages in disingenuous sleight of hand, saying stock issuance to employees is not related to the performance of the stock repurchase program. The word, quote, performance in that context could have many meanings. By inserting an ambiguity, NVIDIA tries to imply the stock buybacks are not related to the share issuances of employees without flat out lying to hide the fact that they are joined at the hip. The buyback plan exists to offset massive dilution from the SBC compensation, and I acknowledge it performs very well at transferring value from shareholders to employees. NVIDIA also argues its stock-based compensation is consistent with its peers, irrelevant, pouting, but they do it too. It is never an excuse for anything. Besides, not all do this to the same degree. An exploration of some algebra that I will address in another post reveals Microsoft's true SBC expense has owners' earnings since 2018 at 86% of GAAP and 77% of Wall Street. Alphabet is at 102.7% of GAAP and 81.8% of Wall Street, and Meta is at 87.7% and 67.4%. Now I gotta go to the comments. I think Burry posts a YOLO at GME. Probably not. He'll probably just write about it. The rest of the article is in the comments somewhere. I think it's that. Is that where it starts? Yeah. Alright. Those turn out better than NVIDIA on the issuance of SBC, but recall from my unicorns and cockroaches posts last week, NVIDIA does not have the questionable depreciation schedule potentially boosting earnings that these others do. Moving along, NVIDIA accuses me of arguing that equity grants were excessive at the time of issuance. Wrong. I am arguing that GAAP SBC expense measures fails miserably in capturing the total cost of SBC. NVIDIA's 2018 to present GAAP SBC expense, $20.6 billion, is now relevant to our owners' earnings calculation. One anonymous survey of 3,000 NVIDIA employees reported that half are worth over $25 million and up to 80% were millionaires. That is what $112.5 billion of shareholder money in the hands of employees looks like. I should note there are other small cash flows here related to old stock options and employee stock purchase programs, but they do nothing to change the big picture's conclusions. Finally, NVIDIA laughably argues that the massive cost of buybacks created value for shareholders, despite the no significant net change in the share count. Plus 47 million shares I rounded down over more than 7 years. Let's see. Okay. There's no guarantee that NVIDIA's intrinsic value is even $51. The share price today notwithstanding. After all, true earnings are possibly only half what they seem, and maybe today's owner's earnings multiple is 60x or more rather than 30x. But even if we stipulate the intrinsic value is higher than $51, 51 would be not only the average share buyback price, but also very near the share grant issuance price. After all, it is a buyback to nowhere. That, my friends, is a hamster wheel, and NVIDIA shareholders are losing it all to hamster heat. Now, I admit, the result above is, in good part, because the stock has been rising dramatically. However, such a circumstance does not challenge validity. This is common sense. The more growth, the less beneficial to holders of common stock for the company to have issued a lot of shares along the way, and the higher the stock price over time. The greater the cash flow that must be diverted from shareholders to offset dilution from all that issuance. SBC creates leaking holes in the fuselage of intrinsic value growth. Let's see. Turns out that this is an algebraic equation at the top of this post. Our adjusted present value formula lays out the relationship between the variables. For a given level of dilution y and a discount rate d, higher growth g means a greater percentage loss of present value. Now NVIDIA has grown so fast that all of this has been empirically a poor reason to stay out of the stock. Generally speaking, hypergrowth with stamina, 50% for 5 years or more, generates future expectations that can take a stock up parabolically, well in excess of intrinsic value. NVIDIA has been well above that threshold. Most shareholders are happy with share gains, even if intrinsic value gains have been less than they could have otherwise be. However, hypergrowth attracts competition and has never lasted very long. With this and other threats looming, it may be worth knowing if your stock is twice as expensive as Wall Street says it is. Also worth knowing that owners' earnings and intrinsic value did not grow as much as the company press release say they did. Let's see. Do I make money outside the stream? You still foot? I make money sometimes. I don't have like a job or anything. I make money when I can. What if growth slows and or stock falls? Would that reverse my argument above? The answer is no. In good part, companies react to falling stock prices by rewarding their employees with more stock-based compensation and higher salaries. Oh yeah, this part is really interesting. It would be nice to have a job, you know, it'd be cool. But it's all good. Having a boss is the worst. Jobs are chill. I don't have any issue with a job. I just can't find one. So I just do what I can. All right. So what if growth slows and or the stock falls? Would that reverse my argument above? The answer is no. In good part, companies react to falling stock prices by rewarding their employees with more stock-based compensation and higher salaries. There's a very recent stark example in 2022 The stock market had a minor correction. Despite the relatively short decline, the richest tech companies in the world suddenly had a major problem with employees demanding both salary increases and more RSUs to compensate for prior RSU grants that appeared to be falling in value. The companies caved. Amazon, for instance, laid off 27,000 employees from late 2022 to 23. This was about 13% of their workforce, the largest layoff among the biggest tech firms. For those that stayed, stock-based compensation skyrocketed such that company-wide stock-based compensation rapidly accelerated through 2022 to 23. Accelerated vesting from layoffs is a factor, but nowhere near enough to explain Amazon's more than doubling of SBC. Later in 2023, the AI boom was in full swing, stocks were recovering, and Silicon Valley employees were sitting pretty with their higher salaries and many more RSUs. By 2025, layoffs were in the distant past, and bidding wars erupted for employees that saw individual compensation packages rise as high as $1 billion for especially talented employees. Here we go again, ready for another massive stock market run with the same holes in intrinsic value fuselage, and eventually the same question, when to pair or sell. Some say SBC is necessary, fine, but Gap and Wall Street do not account for it properly. I have been on this subject for some time. I really struggled with options compensation during the 1990s boom. It was a big expense, and it was not in GAAP accounting, so it was not in earnings statements or filings. This all stems from my inability to simply take a line item at face value, as well as my inability to stop imagining line items that are not there. Once in 1999, I was so deep in options contemplation that I slammed my middle finger in a car door hinge that locked most of me out. I cannot tell you how that could have happened as I was not paying attention. Okay. But my brain caught a thread of logic as I gave the door my middle finger. It all crystallized for me where my finger was on ice, but then came restricted stock units, aka RSUs. A couple years ago, Phil and I came to a valuation solution, as well as a mathematical framework for understanding SBC, and my hope is this post brought our thesis to terra firma. All the hyperscalers appear to have serious earnings quality problems when this SBC analysis dovetails with the under-depreciation thesis. There's more to come. For sure, when general valuations are high above intrinsic value, when temperaments are short, and when animal spirits are particularly agitated, this kind of analysis may not seem to track. Still, stocks' high multiples on earnings and sales necessarily look very far into the future, and times like these historically do not last long enough to justify confidence in that view. As promised, below you will find the full derivation of present value calculations with dilution. Until next time. And then he has a... Oh, it's not there anymore. He has that mathematical derivation somewhere. I don't know where it is. Oh, it's right here. It's like all this calculate value or whatever. But I'm not going through all that. One sec. So that was that. I thought that was an interesting post. Has nothing to do with GameStop really, but cause GameStop gives RSUs to Daniel Moore and a couple other people, and they pay out a little bit. But I don't know. You'd have to probably run the numbers through that derivation thing and to get the real value or whatever. I'm not gonna do it. I don't really care, I don't really care. How long? That's an hour. That's an hour. I don't think there's anything else. So Unless you guys have something, that might be the end here. I just wanted to read that article, have it on stream. I don't know if I'm going to open a lunar pack. Probably not. We'll see. I guess if GameStop goes up a fuck ton, you know, maybe I'll do it for the lulz. But making those power pack videos is a waste of my time, realistically. Yep, I don't think there's anything. It's crazy how much crypto's down. That's wild. I would say crypto's just dragging on the stock market. But who knows? Is there anything else? Yeah, it's good seeing you, Muma. Thanks for stopping in, bro. I hope everything's good. Yeah, I don't think there's anything else to look into here. I saw the short interest went up a little bit. What price is this shitter actually at? 22. Oh, okay, so Yahoo was correct. Market Watch was saying 22.9, so I was like, what? Yep, I think that's it. So, thank you guys for stopping in. Have a good rest of your day. And I'll see you guys when there's something else to talk about. God bless you.